Your jewelry brand has so much potential. Are you ready to take it to the next level? The Jewelry Brand Makeover Masterclass will help you pinpoint what's holding your business back and show you how to grow with clarity and confidence. Learn how to attract better customers, position your brand the right way, and create a sales system that actually works. This is a live event and spots are filling up quickly. Head on over to flourishthriveacademy.com/makeover to reserve your seat today. Are you ready to make 2025 your best year yet? Head on over to flourishthriveacademy.com/makeover and I'll see you there. Finding the balance between how much tax you pay and how much profit you have and how much tax you save is a constant ongoing struggle and conversation for a lot of jewelry business owners and entrepreneurs in general. So if you're wondering how you can build a business that is highly profitable, but also keep more of what you make and save tax from time to time, then you are going to love this episode. Today, I'm interviewing Amanda Handquist of The Fit Financial, and she's going to be talking about different tax saving strategies to help you save more on your taxes and keep more of what you make, if it makes sense. All right, let's dive into today's episode. But before we do, I'm Tracy Matthews. I'm the Chief Visionary Officer of Flourish and Thrive Academy, and I host this podcast called Thrive by Design. I also wrote a best-selling book called The Desire Brand Effect, and I'm here to support jewelry business owners and help them start, grow, and scale successful 5, 6, and 7-figure businesses using my methodology called The Desired Brand Effect. So if you're trying to start, grow, or scale your business and you'd like a little support, tune in because you're going to love this episode and check out many of our other episodes. And with that being said, make sure that you are subscribed to our YouTube channel, that you click that little notification bell so that you're notified every time we release a new podcast. All right, let's dive into this episode with Amanda Handquist. Hey there, it's Tracy here, and I'm so excited to have a financial expert, Amanda Handquist, on the show today. Amanda, thanks so much for being here.
Yeah, Tracy, thanks so much for having me. I'm excited to have this conversation with you today.
Well, I got to meet you recently at a local mastermind here in the Phoenix, Scottsdale, Mesa, Arizona area. And it was so fun because you were one of the speakers, I was one of the speakers, and you were talking about setting up your financials for a business. And then we ended up having a conversation and talking about some of the challenges that small business owners face when it comes to actually dealing with their financials, but not just like setting up your own separate bank account, more in the lines of like, how can you save taxes? How can you plan for taxes? How can you save for retirement when you haven't been doing that because you're waiting for a big windfall or something like that? So I thought I'd have you on the show today to talk to us a little bit more about some tax saving strategies that would support jewelry business owners who are trying to keep more of their profit. So welcome to the show.
Yeah, absolutely. Absolutely. Thanks for having me. More grown-up financial topics, right?
I know, it's so fun. I love talking about money and I love talking about these things. And I also think that we probably don't have experts on the show talking about this stuff that much. So we're going to dive right in. Now, I've heard your story, but no one here has heard your story. So why don't we talk a little bit about your background and how you got into financial planning?
Yeah. So I've always been an entrepreneur I went to college to be in interior design and quickly realized that working for someone else was just not for me. I wanted freedom. I wanted scalability. I wanted all of these things. But what I quickly realized is that I had a spending problem. And so when I started making real money for the first time as a business owner, as I'm sure a lot of your listeners have probably experienced, right? You have all this money coming in and you don't really know what to do with it. We aren't really taught this thing about entrepreneurship and finance, right? And so I remember one day in particular sitting at my office with this mess of bills in front of me, credit card bills, bank statements, loans, things of that sort. And I was just sitting there almost in tears because I knew I was going to have to break this to my husband. And I knew in order for me to be able to scale and really have the grown-up business that I wanted to have, I was going to have to deal with this mess. And so I had that difficult conversation. It was the worst conversation, but it was the best decision I had made because what it did is it taught me that avoidance is not going to help my situation, right? Avoiding this further is going to prolong the good things from happening.
Financial avoidance. I like it. We talk about
Yeah.
avoidance in relationships or like
Yeah.
attachment styles, but
Yeah. Yeah. Financial avoidance is a big thing, right? Just swipe the card. We don't really need to worry about it.
yeah.
And so, yeah, so I eventually took this to my husband. We built out a plan. We worked it out together and really like it was me doing the work, but it was really him being my financial accountability partner to,
Mm,
look at my books and make sure I was doing what I said I was going to do. And so that was like just what I really needed at that time. But what it did is it really allowed me to scale my business for real and to quit like pretending that I was scaling because I was making all this money. But it was a situation where if I wasn't constantly living this rat race on this hamster wheel and making this huge amount of money every month, I couldn't outpace my lifestyle. And
yeah.
so once I finally put all those working pieces into play, I was able to really scale my business in a big way. And eventually I was able to sell that business. So in the financial services industry, it's a really great opportunity to be able to sell a book of business that you've built. And I was able to do that at a young age and create this thing called financial independence.
That's
And
amazing.
yeah, and it's fun because that allowed me to do what I wanted to do, which I thought was what I wanted to go into the health and fitness space.
Oh,
And
interesting. I
so
didn't realize that's how you were connected to Felicia.
yeah, yeah. So I went into the health and fitness space. I was like, I'm going to be a health and fitness entrepreneur. I'm going to be like this online health and fitness influencer and like teach like busy moms how to get into shape and do all this stuff. And I started going to, masterminds in the health and fitness space, business mentorship programs, because I'm like, I've built a financial business, but I've never built this kind of business. And what I quickly realized is none of them had a clue what to do with the financial side of their business.
Yes.
And that's what I was getting asked about. And that's what we were getting asked to speak about. My husband is also in the financial industry. And we had this sort of come to Jesus moment that this is what we need to be doing for entrepreneurs. We need to be teaching them about how to save for retirement, how to basically get themselves out of the situation that I had myself in so
Yeah.
they can truly scale, so that they can create financial independence. And
So I
that's
know I know the topic of this podcast isn't necessarily about like how do you get out of debt, which I feel like I should interview you again about that.
yeah.
But what were some of the just like a high level, like what were some of the steps that you took to do that and how long did it take?
So my debt, I think it's a little bit different for everyone. For me at the time, being, a 20 something new business owner and having, I think it was right around like $42,000 in credit card debt was
Wow.
astronomical, especially when I was making the most money I ever had made as a young business owner. And it was one of those things where the very first step was just laying out all the cards, laying it all out there, quit avoiding, right? That's the messy start and it's the boring start, right? It's not, everybody wants like this magic, like, what's the magic thing that you did or the app that you took, advantage of? And it was none of that. It was just laying it all out there. And then it was figuring out what's the best method for me. So like, this is again, a debt payoff strategy, which is not what we're talking about today. But what worked for me was the whole snowball effect of paying the smallest thing first, because I'm a checklister, right? Some people are not checklisters. Some people are what's the smartest thing to do first, which would be to pay off the highest interest first, right? That's the avalanche effect. So you really have to try to figure out what works best for you. But yeah, I avalanched that stuff and I actually paid it off rather quickly because I was making so much money, and which was sad. I was making all this money. I had nothing to show for it other than cute shoes and, a nice car and all this other junk. But eventually did it. And then I was able to really, stockpile money and expand my business and then grow it quicker and faster and scale
Yeah.
it and then sell it. So
That's awesome. Oh, I'm excited
yeah.
to continue learning from you and also talk about taxes because I know as someone who's been an entrepreneur for 30 years, I've had a few run-ins with the IRS, not
Yeah.
intentionally, but I've been audited twice.
Yeah.
And I also do believe in the balance between having a lot of write-offs so you can pay fewer taxes, but also finding the balance between that and having a profitable business. And so
Yeah.
I wanted to have you come in and talk about some of your favorite tax saving strategies that might be helpful for a jewelry or product business owner, but also talk about the difference and the balance between like how profitable do you want to be and how much do you want to try to get your taxes down and what's the difference between those two things. So where would you like to start? in chatting with us today.
Yeah. So I think it's important to number one, have a plan. Without a plan, it's hard to know where we're going. Right. And so
Mhm.
I think a lot of times we have avoidance because we simply just don't know what to do.
Mhm.
And so if we can have a plan, especially if we're talking about taxes, what is your tax saving strategy? And when I say saving strategy, how much of your revenue are you going to set aside to pay for your taxes? Right. Because we're going to have something due. Whether like nobody's ever going to have like a $0 tax bill. And if you do, we have other issues to work on. We have a revenue issue, but we want to figure out how can I save some of my revenue and put it aside for taxes? Am I going to automate that? Am I going to have like join like Chase Bank where I can automate a lot of my savings and just have a business savings account that I label tax, and that's just where my tax goes. I'm going to put 5 to 10% of my revenue into that to save for this tax bill that's going to be due every quarter. Like, what am I going to do for that? And so I think that's where we want to start, is have a plan. Or am I going to do like a financial Friday where I'm going to just make
Yeah.
sure my allocations are going into where they need to go? So that's just like some of the ground foundational work that we want to work on first. And then I think as far as like how much or what do I want to show for like a profit? I think that's super dependent on what do you see, not only like in the near future, but in your long-term future. Like, what are your goals? Do you
Mhm.
want to buy a house pretty soon? If you want to buy a house, you have to show that you're profitable. You have to earn income. The bank doesn't want to see that you're not paying taxes, because that means you're not a profitable business. They're not going to lend money to somebody that doesn't have money.
Interesting.
Right. And
Yeah.
so whether you're gonna, buy a second home, buy your first home, or maybe you want to expand your business and you're going to need lending for that. So it kind of depends on what you want for your immediate future as far as how much of a profit. The other thing is, if you don't have like a high tax bracket issue right now, then you don't really need to spend a lot of time and energy trying to drive down your tax bill because it's already low. So that's
Mm.
kind of it. I think sometimes we get caught up in this TikTok world of these cool strategies that sound neat
Yeah.
when we don't really probably even need to worry about it.
That's cool. Well, I love the idea of having a plan. I also want to address something that you spoke about earlier, which is automating whatever you can. I feel like
Yeah.
one of the best ways to automate savings, as a business owner, like you're advised, hopefully by your financial advisors or bookkeeper or someone, CPA, to like how much you should be drawing from the company, also how much you should be paying yourself as a salary, if that makes sense for the type of entity you have. But one
Yeah.
of the things that I found super helpful is the more that I can automate the actual like savings part, the easier it is to remember
Yeah.
to save.
Yeah. And then you don't even realize that it's gone too.
Yeah,
I think that's
just
the
do it.
biggest thing. Yeah. It doesn't hurt that much when like you don't even see it anyway. It's just
Yeah.
in there.
When it comes to the IRS and figuring out like what are some of the best tax saving strategies or things that you can actually write off from your tax bill that makes sense depending on where you are. And then I'm going to have a follow-up question after that, like how do you know which ones are applicable to you? So let's start
Yeah.
with some of those things.
Yeah, hopefully I can answer those along the way while I'm talking about each
Yeah,
one.
perfect.
But I think the very first one is taking advantage of what you already have. Because I think a lot of times that we forget the simple stuff, the low-hanging fruit, so to speak, just the standard tax write-offs that we already have access to. So and I talk about this a lot and it sounds so simple and foundational, but it really is like separating those finances, because I think a lot of times we're paying personal expenses out of our business accounts that we don't realize it. And
Yeah.
I'm all for taking advantage of whatever you can. I don't want to ever leave the IRS a tip, but I also know if I'm paying my vet bill out of my business account, I'm not going to really know the numbers in my business, right? And
Right.
so it's just really important to make sure that we are taking advantage. Not only that, but if you do get an audit or you do get a red flag, you could jeopardize some of those other expenses that you're already deducting for actually counting. And so we just really want to make sure we're separating those finances appropriately. And keeping track of it helps us to remember that, coffee meeting that was 7 months ago that I need to make sure I'm writing off in my business. So keeping track of all those things as we spend them is going to be huge for write-offs. And the biggest thing to keep in mind with the IRS again, I'm not your CPA here, so I always want to advise that you talk with your CPA for your own specific situation. But because we don't provide tax advice, this is just, our point of view here. But anything that the IRS considers a write-off is reasonable and necessary for your business.
Yes. And so I love this. I love this conversation for a couple of reasons. And I want to share a story with you of something that happened. I think I briefly mentioned it at Felicia's mastermind, but I got audited twice. One was the year that I closed my first business. And that I found out later that that's customary. You oftentimes will get audited if you just shut a business down and stop.
Sure.
Put in a final tax return. So that was super stressful because I just come off a bankruptcy. I don't know if you heard this story, if I told this to you, but in 2008, in September, basically my business was taken out by the Great Recession because all these stores that I shipped to basically were filing for bankruptcy. It was like awful. Like I didn't necessarily do anything wrong. I just got caught in this this domino effect, and I couldn't recover from it, nor did I want to recover from it. So in 2010, I think I got my first audit. The second audit came like a couple years later, which was really surprising to me. I just started my new jewelry company. And I think that what happened is I asked my CPA, I'm like, can I write off clothing for my photo shoots? And they said, yes. And for some reason, something happened with like a deposit I made in my bank account, maybe the amount of money that I deposited or something. It flagged the IRS, and then they started digging into my tax returns. And because I was like in a state of PTSD from the bankruptcy, when I got the letter from the IRS, I was panicked. I'm like, I can't go through this again. It was so stressful. So I probably had some choice words for the IRS agent. And then the lady went down a rabbit hole and like crucified me. I ended up having to pay $50,000 in additional taxes that year. And not just taxes, but also taxes and fees to like hire the person to fight the IRS, because I knew emotionally I couldn't go through it again, because you don't want to get into an audit, and you especially don't want to get into an audit doing it for yourself, because what could happen is they're literally like, okay, can you find the receipt for this invoice and tell me what that is for? And you're like, they're like receipts from like 5 years ago. You're like, I don't know. But the big thing was that I was at another mastermind event a while back, and the guy running the event is like, you can write off clothes if you wore them in a video shoot. And that was the huge thing that they took out. And I didn't know this, but reasonably you could write off things that maybe you wore just for something, or if you have Rent the Runway that I don't know, this, maybe you can answer this. Like if you do Rent the Runway for video shoots, and that subscription is something maybe you write off. But I was writing off the clothes that I would wear for business. And it got taken away, and I got penalized for that. So there are certain things that some people will do that are kind of like gray hat, would you say? That maybe you could do it, but like, is it worth doing it?
And I think that's a thing that a lot of people don't realize too, is you can ask your CPA and they can give you their best advice, but at the end of the day, you are the one that's still responsible. And so if you're like maybe feeling a little bit grayish about it, and now everybody can kind of take things how they want to, but if you feel like this is a little bit gray, you have to use your own discretion regardless of what your CPA told you, because ultimately you're the one that's going to pay that bill, not your CPA.
Yes. And I personally, I'm all for getting the maximum tax write-offs. That was like the one thing, because I heard it come up, and I've heard it come up over and over again. People are like, well, I do content. Can I write off clothes? Like, probably not.
And a lot of people, especially in the health and fitness space, do workout videos, they're always wearing, stuff that they can consider a write-off, but is it really? Like there are some things, like if you literally have your logo printed on it, that's a little bit different than you can, because obviously it's being worn to show off your business. But that's a good one that you bring up. Anything ordinary and necessary. I think those are the two key words that anytime you're using a write-off that you can use to justify it.
Awesome. Okay. So what else, Amanda?
So number 2, and we talked about this a little bit, but it is the S-Corp versus the LLC, depending on your situation. So I think the term S-Corp is oftentimes thrown around without really anybody understanding why on earth you're going to use an S-Corp, right? It's not just like a cool name. And it's not just means that you're a big kid business now. There's an actual reason why you would want to do an S-Corp versus an LLC. And you don't want to have to do it if you don't need to, because it's
Yeah,
a pain in the butt. There's a lot more
it
work
is.
to it. You have to do payroll. You have to be a W-2 employee. You have to have FICA taxes and all these other things. And so I think it's important for people to understand that if you have between 50,000 or about $50,000 of actual profit is where you're going to want to be before you consider. And again, every situation is different. I always have to give this little disclaimer, but that's going to be around where you want to be. I'm not saying revenue, I'm saying profit before considering an S-Corp, because it is more expensive. There are, filings that you have to do, more paperwork involved, more red tape. But what that's going to do is it's basically going to help you avoid paying some of the additional FICA tax that you would otherwise be paying on all of your profit. So when you give yourself that W-2 wage as an S-Corp, what you're doing is you're only paying FICA tax on that W-2 wage and not the remainder. But
Yeah.
again, you have to pay yourself a fair and reasonable wage, what you would pay somebody in your position. So you're not going to pay yourself $10,000 because you only want to pay FICA on that. That's another red flag, right?
Yeah, for sure.
And we also don't always want to drive down that FICA or drive down that W-2 wage to avoid paying FICA, right? Because not only is that a red flag, but sometimes we could be jeopardizing some other things like a qualified business income deduction. And so
Mm,
again, it's always important to speak with a qualified professional about your situation, because if you're somebody that makes more than $250,000 in profit, you may actually want to pay yourself a higher salary so
right.
that you can get more of an advantage. You can pay more contributions to retirement accounts, things of that sort. So it's all dependent on your situation, but the S-Corp strategy is my number two.
Yeah, that's interesting. So I'll tell you a funny story. I was sharing this also at that mastermind. We were talking about this.
Yeah.
But I heard about this tax deduction. Oh, if you're making a certain amount of profit, you definitely want to be an S Corp. And because I was on a bootstrap and a shoestring budget back when I did this, I remember I had an LLC and I went to LegalZoom to set up my S Corp in New York City because I had researched what it would cost to hire an attorney to set it up. And I'm like, well, I don't really want to pay the extra $2,500 or whatever it's going to be. I could probably just do it on LegalZoom. So I did that. But the problem is that I set up my S Corp on LegalZoom and didn't properly wind down the LLC. And then I had these two entities and it caused me problems forever. I just thought the IRS would figure it out. Like it's the same tax ID.
Sure. Yeah.
They didn't. And so note to self, do not do this yourself. Hire a professional or get professional advice. Because what I learned later is that you can actually keep your LLC and just file as an S Corp. Do you want to talk about that?
Yeah, it's just a little election that you can file. It's just an extra paperwork. You can basically turn your LLC into an elect S Corp. It's as simple as that.
Yeah, and so that's what I did when I moved my entire company to Arizona and we reincorporated here. We're just an LLC. We have a holding company. Now everything kind of runs as a flow through the companies down to me, but we file an election as an S Corp, which makes it so much easier.
Yeah, but I will say, and it is simple, but there are, there is a lot that has to be done. There's things that have to be filed. You always, again, like you said, Tracy, want to make sure that you're hiring a professional to do it because things can get missed. Yeah, you guys are experts in the jewelry field, not the legal paperwork field. Exactly. So let's make sure that we hire the experts to do those things.
This is true. What is your tip number 3?
Yeah, the tip number 3 is the Augusta Rule or strategy. So this one is really cool.
Good. I love it.
Yeah. So to keep in mind with this, you have to be a homeowner. All right. And then also you have to have a business entity. So as we just talked, S Corp or a partnership or things, anything like that, a C Corp, most of you probably are not that, but you have to have some kind of a business entity. And so if you're a homeowner, have a business entity, you can rent your home from your business up to 14 days. And you can pay your business to do that. Maybe you're holding a mastermind. Maybe you're holding a podcast retreat. Maybe you're holding some kind of event at your home. Now you actually have to do it. Like you can't just like say that you're doing it and just transfer the money, you need to have some kind of a paper trail. You need to have a signed lease agreement between your business and yourself. You can call a couple of venues and see what the going rate would be for that particular, time frame or event. But it is a really cool strategy that you can literally pay yourself from your business and not have to pay the tax on that. So it's a really cool strategy to take advantage of.
I love
Now,
the Augusta Rule. I've been using it for years, and it's great for
yeah,
people like if you're having my CPA said like if you're having a filming day and you would have to rent a studio, you can like basically rent your apartment from yourself as if you were like a TV studio
yeah,
renting your apartment or home or whatever it is from yourself. And so I found out about that tax strategy like years and years ago, and we've used it. I have heard though that, it's one of those things, it's a little bit like gray area. So you definitely want, like you said, have the paper trail and make sure that you're
yeah. You want to have your
paying
ducks in a
attention to it.
row.
Yeah.
Yeah, because it's going to cost you a lot more to have to go back and pay for it than
Yeah,
it would
exactly.
be to have not done it in the first place. So just make sure you do it correctly. And then also don't go to your CPA on April 14th and expect them to implement this for last year. Like this is something you want to do ahead of time, do your
Yes.
homework on. I am going to come out with a resource guide on that. So you can all share my website at the end, but you can stay tuned for that.
Let's pick number. Are we on number 4?
Yeah, we're on number 4, and it's funny because I actually have 6. So
Okay. Let's pick number. Yeah,
if
perfect.
we get to them, great. If not, no big deal. But
Let's do
the
all
next one
6.
is
I like
the
it.
next one is hiring your kids. So I
Ooh.
I especially love this one because I have 3 kids, and one of them's too old now. He's actually a grown up, well, 18. But so basically what hiring your kids is doing is it's creating tax efficiency. So we're efficiently taking money from your business and shifting it over into your kids' tax bracket at a potentially 0% tax, right? And so
Mm.
the ideal age for this though is between 7 and 17. So it's funny, like I did a reel on this, how like I think it was Jay-Z or not Jay-Z. Who was it? I don't know. They paid their baby to cry in one of their music videos,
Oh
right? And
my
so it's
gosh,
like,
that's brilliant.
yeah. And so, but it's like, obviously a jewelry business would not be able to do that, right? And so like, what can we hire our kids to do? And it has to be something that you would actually pay somebody to do. So would you hire somebody to print shipping labels and put them on a box and take them to UPS? I'm trying to think of something that you in your
I know
business.
something.
Yeah, go ahead.
So my stepdaughter, I mean, I don't know, she's my stepdaughter and I'm not married to Jason. So I don't know if this technically counts, but like, let's say Jason wanted her to do video research on things for like content, like those funny memes that you post, like the time
Mhm.
that she spends on that, we could pay her for social media marketing tasks. Or sometimes I don't have time to like respond to all my DMs. So I hand my phone to them and they're doing
Yep.
the DMs. I definitely think shipping labels, carding the jewelry, bagging the jewelry, packing, shipping, packaging, like all those things. There's a million things
Yep.
that I feel like kids could do easily.
Yep, absolutely. And again, it has to be something that you would legitimately hire somebody else to do, and you want to pay them what you would be paying that other person that's not your kid, right? So we don't want to pay our daughter $10,000 to take the trash out, right? And so I'm just trying
Yeah,
to think of a crazy example, but it has to, again, everything is reasonable and necessary. So it's just another strategy that we can take advantage of. And I think it's also really teaching our kids good habits with money. We're
Mhm.
teaching them what we do in our business, the passion that we have in our business. Like they're seeing that firsthand when they get to be a part of it. They're seeing why mom has worked late so many days or gone in early so many days. Like I think when they get to be a part of that, it means a lot more to them. And then when they also get to learn how to earn and learn how to save at a young age, we weren't taught necessarily how to do that. At least I wasn't in the way that resonated with me. So I think it goes beyond just like paying our kids. I think it means a lot more too. There's a purpose behind it.
I love that. All
Yeah.
right, what's going on? Let's tip number 5. Let's do this.
Yeah. So tip number 5, I'm a little biased too, which is retirement account contributions. But everyone's situation is different. I know that I sound like a broken record, but it really is important for me to say that because not everybody's going to be the same here. So there's things called Roth IRAs. This isn't necessarily a tax saving strategy for you right now, But as a tax planner, we're always looking at your taxable situation over your lifetime. We're not always looking at driving down your tax rate this year, right? Like we want to look at, okay, when you're 65 years old, are you going to be paying a crazy amount of taxes because we didn't do efficient work for you right now? So that's the power of tax planning. We want to make sure that you're efficient through your lifetime. And so if right now you're at a lower tax bracket because maybe your income level isn't quite as high, we want to take advantage of something called a Roth IRA because you've already paid taxes on that money and now it's going to grow tax deferred for, till you're 65 years old, 59 and a half. And so Roth IRA is really cool early on. But when you do get to a point where you're going to need to start taking advantage of some of the taxable retirement contributions, then we're going to be looking at like 401ks and solo 401ks. So if you don't have employees, you're going to do a solo 401k. And I don't mean contractors, I mean like W-2 employees. So if you want to be taking advantage of a solo 401k, it's nice because you have less compliance, less costs, less red tape than you would have if you had just a regular 401k. But if you have employees, then you'll want to do that regular because everything has to be the same for your employees as it is for yourself. But what's cool about that is that the employee can contribute up to 13 or 23,000 per year. And then the employer can do what's called profit sharing. So you being the employee and the employer get to sort of double dip on both sides for that contribution. So it's a really great way to take advantage of once you start getting to where you really need to put some money away, you can really start stashing some money in there.
We're going to have to talk about this because I want to start a profit sharing program by the end of the year.
Yeah.
And I'm curious to hear how that works with the 401k.
Yeah.
Okay, cool. Amazing.
Yep.
And then what's your tip number 6?
So I also wanted to mention that if you are not somebody that has an S-Corp or employees yet, you can also do a SEP IRA. Like if you're just an LLC only, but then that's just like 25% of your net income that you can put into your retirement contributions there. So just a little side note on that. And then the last one, so number 6, so I guess you guys get a bonus today. So I have more than 5, but number 6 is depreciation. So I'm sure everybody's heard about, the whole G-Wagon thing and buying my car and writing it all off in 1 year. Again, I think this gets all too carried away, like on TikTok. Like we just want to buy the car, but we don't really know why we're buying it. It just sounds cool because I get to buy a car and my business pays for it. Like there's an actual reason behind that, right? Number 1, it's because you need the tax write-off, right? You need the depreciation, you need the deduction. Maybe you don't necessarily have the cash for it. That's probably not a very wise use to go and buy a car, right? And so we always want to be looking at your situation. If you have the cash just sitting there and it's going to be taxed on, then we might want to look at this thing called depreciation. We might want to look at buying the vehicle. The other thing is this whole accelerated depreciation. The reason why the whole vehicle thing got blown up is because in 2017, this was passed that you could accelerate depreciation to 100%. So typically, if we were purchasing an asset for our business, we could buy that asset, but then we would have to depreciate that asset over 5, 7, 10 years of time. We couldn't take like $100,000 vehicle and write that whole thing off in 1 year. Does that make sense? So now though, that rule is starting to sunset. So actually in 2024, you can only depreciate up to 60% of that asset. And then next year it'll go away unless it's renewed by Congress, and that's all politics from there. But
so only 60% of the vehicle, but can you depreciate the rest like later or?
Yep. So the remaining 40% then would be like each, 5, 7 years, whatever your CPA feels is your best for your situation.
Now, doesn't that have to be like over a certain weight or pounds or something like that?
If you're going to use the accelerated depreciation benefit. Now, if you're just going to utilize it for the standard depreciation, then you can choose whatever vehicle you want. But I will also say business vehicles are tricky, especially like if you work from home, because it's not like you have to go drive to the office. It's not like, you know what I mean? So you have to use it at least 50% of the time, specifically for your business. and you have to be able to tell the IRS that that's what you're using it for, right? And so there's a lot of things there that are involved with all of that, but it could also mean other equipment too. It doesn't necessarily. I don't know if you guys have certain machinery for boot jewelry businesses or things like that, but
Lots of it. And, this is funny because, well, a lot of jewelry makers and business owners, they do like pop-ups and shows on the weekends, depending on the business model, right? So
yeah.
there's so many different ways to sell jewelry. It's like you could sell in like expensive luxury stores, but then also at a craft fair. So we have this one designer who actually sells out of the back of her car. So I'm assuming that is a legitimate business write-off.
Yeah.
If
I mean,
she's
definitely.
using that as
I'm
a trump.
obviously going to say talk with your CPA, but
Yeah.
in my professional opinion, I would say yes.
Yeah, I just had her on the podcast. I haven't released the episode yet because we ran out of time slots. And so the next time we do a launch for this one program, I'm going to feature her story. But it's so cool because she was sharing like, yeah, well, I found out a way that I could just set up my booth inside my car. So I just have to like lower the hatch and like back into my shows, and it like basically saves me so much time in selling, and then I can actually sell at any given time.
I love that. I love that creativity too. That's awesome. Yeah.
So Amanda, do you want to just recap the 6 tips really quickly and we can go from there?
Yes, absolutely. So number 1 is just taking advantage of what we already have. So the tax write-offs that we're already utilizing, making sure that we are documenting things, keeping track of our expenses, whether that's through a bookkeeper, a software, or a spreadsheet, because we tend to forget things from, 7, 8 months ago. The second one is the S-Corp, going from an LLC, electing as an S-Corp, or maybe you're just starting right out as an S-Corp, whatever that looks like for you, but doesn't make sense for you depending on your profits, depending on your net income, to take advantage of the S-Corp strategy. The Augusta Rule, you have to be a homeowner. You also have to be a business entity, but you can rent your personal home for up to 14 days for business use. And then number 3, hiring your kids. Basically, we are creating tax efficiency. We're taking money from our business and shifting it to our kids at a potentially 0% tax bracket to help tax efficiency, but we're also teaching them about money too, teaching them how to work in our business as well. And then, actually we're on number 5 now, retirement account contributions. So yeah, this one's big. We don't know if we're going to have a sellable business. We hope we will, right? But in case we don't, we want to make sure that we are saving for our future, saving for our retirement, but also taking advantage of tax strategy while we're doing it. And so having some kind of a 401k or SEP IRA is going to help you do that. And then also finally, taking advantage of depreciation. So I think most popular concept here is to buy the car for your vehicle. That's just the thing that's the most talked about. Doesn't necessarily have to be a vehicle, but being able to buy that large equipment for your business and then write it off up to 60% in 2024 or depreciate it out over the next few years, depending on what your CPA recommends.
Look into the laser welder, people. I'm just kidding. Amanda, thank you so much for being here today. Where can everyone find you?
Yeah, so I have an Instagram account at the Fit Financial _. And then we also have some resource guides that you can download on our website at fitwealthadvisors.com.
Awesome. This is amazing. Thanks for being here.
Yeah, absolutely. Thanks so much for having me on.
Thank you so much for listening to the show today. This is Tracy Matthews signing off until next time. If you haven't done so yet, make sure that you pick up a copy of my best-selling book, The Desired Brand Effect. Stand out in a saturated market with a timeless jewelry brand. You can grab that over at desiredbrandeffect.com and grab your copy today. Ciao for now. Before you go, I wanted to share something near and dear to my heart with you. If you're someone who would like to turn your content into a consistent sales machine and profits, listen up. Laying the Foundation is the program that has helped thousands of jewelry business owners just like you to attract high quality, high value, repeat buyers who buy every season. That loyalty is something that we are experts in. So if your sales are stocked and you're posting content that is not making sales and you feel like your marketing efforts are just a waste of time because neither your audience or your email list nor your sales are growing, well, then this is your time to do something different and break out of your rut. to make daily sales the norm. If that's you and you're interested in learning more, head on over to flourishthriveacademy.com/LTF. That's flourishthriveacademy.com/LTF, and check out the case studies and the Laying the Foundation program for yourself. I promise it will change your life. Let's do this.